Hey everybody, Derick Van Ness back again, investor, wealth strategist, and life adventurer. And I've got something for you today that comes up every single day for me, and that is the question of what's the difference between whole life insurance and term life insurance? Which one should I buy? Which one's garbage? Which one's great? And the short answer is that there's a lot to it. So we're going to go through that today in the next couple of minutes. By the end of this video, you're going to know exactly which one is the right one for you, because the honest answer is, depending on what you're trying to accomplish, either one of them can be the right choice right now, and that may change in the future. So let's dig right into it. Before I jump into it, let me remind you, if you're liking this kind of content, if this kind of stuff helps you, smash the like button, subscribe to the channel, let friends know. I know a ton of people have questions about insurance, financial strategy, real estate investing, mindset, all of that stuff. That's what we do here at the channel, and I really want to help you. So today, nuts and bolts. Let's talk about term insurance and whole life insurance. We'll go over those first. If you're interested in universal life, that's a different video, and we can do that another time. So first, let's talk about term insurance. So term insurance is affordable insurance that is meant to last for a term, like a presidential term, a period of time, right? Typically, you'll see policies at 10, 20, or 30 years. Yeah, there's 15 and 25 years, but 10, 20, and 30 years are the most common. So why would you buy term insurance? A couple of reasons. Term insurance is meant to insure for a temporary insurance need, right? So, like if you buy a house, you might get a 30-year mortgage. You'll have a 30-year mortgage, you'll get 30-year term insurance, so that as you're going through paying down that mortgage, if you pass away somewhere along there, there's money in there. There's money that comes from the insurance to pay off your house for your family. Or you might, but once the house is paid off in 30 years, you don't need that term insurance anymore, right? So no need to insure beyond that point. A 20-year policy might be when your children are born. If you want to make sure that there's money there for their education, which 20 years from now, they'll be into their education and probably be okay. So if you're not around somewhere along that 20 years to help pay for their education, there's money for that from the insurance. And then a 10-year policy, like most commonly I see this for people who just need insurance to cover their family, and they need it really affordably. Now, the good thing about term insurance is it covers you for a death benefit, and it does it very affordably relative to other options, in the sense that it's a very small payment, right? Now, the problem with term insurance is it doesn't build any equity. When the policy expires, you can either lose it, or if you renew it, typically the cost will be significantly higher. Now, there are term insurance policies out there that aren't 10, 20, 30 years. They're called one-year term, OYT. Those renew every single year. So every year as you get a year older, your payment gets a little bit higher, a little bit higher, a little bit higher. And it can become very unaffordable as you get older, right? So each of those has their pros and cons. Here's an easy way to think about term insurance. It's kind of like renting an apartment. When you're young and you're in school, or you're not making a lot of money, renting an apartment can be a great idea. You can live in a great area or a better area. You don't have maintenance. You don't have to take care of everything. The payment, what you get for the payment, is really, really good. It's very affordable. The problem with term insurance and with renting an apartment is, at some point you got to move, right? And when you move out of the apartment, you don't have anything to show for it. You've paid in and the payments were lower, but you don't have anything long-term that's being built by those, right? So I believe for most people, term insurance is where you want to start, but it's not where you want to end up, right? Just like in real estate, you may want to start by renting an apartment or renting a house, but eventually you probably want to own one, because you can pay them off and they do build equity and tax advantages. And we're going to talk about how that relates to whole life in just a minute here. But so there's nothing wrong with term insurance. The only other thing I'll say is this: from an investment perspective, a lot of people say buy term insurance and invest the difference, because whole life, the payment is higher, and we're going to talk about that. The problem with that for a lot of people is they buy the term insurance and then they don't invest the difference. So I'm not a huge fan of that particular way of going about it. I think there's a better way. But if you're doing buy term and invest the difference, and you've determined that's the way you want to go, what I would like to say is, if you buy term insurance, you need to absolutely set some money aside to begin building that investment part, or that savings part that you're going to build elsewhere. Okay? So that's term insurance. Now, let's compare that to whole life insurance. So whole life insurance is permanent insurance. It means it's meant to last your entire life, unlike a term, which is for a period of time. And it will, if you make the payments, it will pay out. It's never going to change in price with whole life insurance. Once you determine what your premium, your cost of insurance is, that will never change, right? So the thing about whole life insurance that gets knocked sometimes is that it's really expensive. And here's the thing with it, is the payment is higher, but it never goes up, and it's gonna pay out for sure. So what happens is, as you pay into the policy over time, some of that money not just covers the death benefit, but it builds a form of equity. It's called cash value. It's kind of like having a pseudo savings account type vehicle inside of the life insurance where there's money in there that you can access. You can either withdraw it, which I don't recommend, or you can borrow against it, which is a whole nother thing, but the bottom line is you can get to that money. It builds equity, it builds value. There's also a way to do whole life insurance where you can put extra money in, like if your cost of insurance is this much, you can put money on top of that that goes directly into the cash value and will build the policy value much more rapidly. The reason a lot of people don't love whole life insurance is the first couple of years, if you don't put that extra cash in, this over and above the cost of insurance part, it takes a long time for the cash to build. So people who say that it's very expensive, what they're looking at is you pay in for the first couple of years, you don't have a lot of cash to show for it. You do have a permanent death benefit, which is fantastic, but if you're really looking at this as a vehicle or a place to store cash, that's probably not the most effective way to go about it. Now, the money that goes in there into the cash value with life insurance, whole life insurance, is something that separates it from term insurance. Term insurance only has the death benefit. Whole life has the cash value. The cash value over time will earn for you, depending on the type of company you use. I usually work with mutual companies that pay a dividend, so there's a guaranteed rate of return. And on top of that, if the company is profitable, the insurance company, they'll pay you extra money on top of that, so you have an upside inside of the policy. Now, so you've got earnings on your cash value, which is different than term insurance. Your payment's a little bit higher, but it never changes, and it's a permanent death benefit. And the growth inside of the policy on the cash value is also tax advantaged. You pay taxes before you pay your payments on your life insurance, but once the money goes in there, it grows tax deferred, meaning you would pay on it when you pull the money out. But if you use the loan provisions, you may not end up paying taxes on that anyway. Now, the big advantage to whole life insurance is it creates a guaranteed rate of return. It does save you in taxes, and it does provide a death benefit that you know is going to be permanent. So you know it's going to pay out for sure in the long term. So it's very much like buying a home. A house payment is usually more than an apartment payment, but some of that money is going toward paying off the house and building equity. Some of that money might have tax advantages like being written off as interest or depreciating the property. And over time, a house goes up in value. If you overfund life insurance, meaning you put the extra money straight into cash, the value of the life insurance policy will go up over time. So it's kind of like appreciation on a house. So the question always becomes, should I buy the cheaper policy that doesn't build any cash, or should I buy the more expensive policy that builds cash over time? Now, I say the more expensive policy with the whole life insurance, but the truth is eventually once you get enough cash in there earning for you, that policy becomes much cheaper in the sense that if you take your earnings plus what you're paying in, the cost is going to be less than the term insurance policy over the long haul. So there's a lot of math behind a lot of that, but the big difference is one's permanent, has tax advantages, grows cash, builds equity. The other one is much cheaper, much smaller payment, but it only covers your death benefit. It doesn't build anything long term. So my belief is if you're in a tight situation financially, or you need to just cover a big need for a business loan, a home loan, child's education, term insurance might be the right choice for you while you're taking care of that need. Long term, you want to end up in life insurance, whole life insurance. Now, the key with whole life insurance is you want to make sure you work with a team that's going to maximize the cash value, maximize what you're trying to accomplish while minimizing their fees. Life insurance can be very expensive from the fee standpoint if somebody is maximizing their fees and minimizing your cash value. We hate to see that. It gives life insurance a bad name. Just like every tool out there, there's a right way and a wrong way to do it. Depending on what you're trying to accomplish, you need to structure those policies differently. So if you need help with that, we can explain more. But I just wanted to give you the basics of term insurance versus whole life insurance and the difference between the two. If you have questions about that, please pop them in the comments below. If this video has been valuable, hit that like button, subscribe. We do a couple of these a week, and I'd love to share more and more of these with you over time. But truly, if you have questions about life insurance, we're here. Just go to our website, biglifefinancial.com, and set up a time to talk with us. Myself or someone from the team would be happy to help you, because this is a situation where it depends on where you're at in life. They both do really great things for the right person, and you just need someone who can give you objective advice on how to do that. Anyway, my name's Derick Van Ness. Really appreciate you stopping by, and I look forward to seeing you on the next video. Thanks.